What's up, folks? Heine's New Year update. So I'm going to give you a quick update about what I think 24 will bring, or what I'm expecting. Anyway, if you look, Jan opened up down here, so we opened up 23, and then we just kind of kept going. Parked it down. We did retreat into that level I talked about for a long time. This is going to be still a substantial level, and moving forward, we just rocketed up after we bounced off that. Your 50 day is still at 51.18. Your 100 day, although I don't typically watch that, is at 44.72, and 43.77 is your 200 day. So even if we dropped roughly 500 points, we'd still be roughly at the 200. So from a structure overall, I don't see anything crazy or bearish or whatever. The things we are looking, or I'm looking at, is the fact that the short VIX trade is probably pretty crowded. So that has the potential to to blow up. And if that happens, then we could see, some of these downturn levels. But, 800 points into, even to here is a 20% move. So, I don't see that craziness. Here's the weekly. I put yearly pivots on this just for grins. 53.65 is your R2, almost 6,000 is your R3. Your R1, 46.16, that was an interesting level right there. We popped, dropped, and then bounced back above it. So we are above it. These aren't etched in sand. I don't, there's obviously some leeway between this level, and my 200 day. The 200 day on the weekly, I would suggest you all put that on your charts because from a macro aspect, it holds incredibly well. So typically any dip down, now this is obviously COVID, we went down below it for a few weeks, and then once we got above it, it was, it was on like Donkey Kong. We just went straight all the way up to new highs. And I remember that rally, it was mind blowing. So, we have to keep in mind that can still happen. Here's your dip down here. And then your dip to my other level here, and then we continued up. So I would expect this year we would get some. Obviously, we're going to get pullbacks. I don't see an end of the world market crash scenario unfolding. I would say 45.26 and the 43.97 are going to be my two volume node areas that would be support if we were to fall from these highs. Typically, what I want in a downturn or a crash is everybody to get bearish and think it's all over, and that's typically when your reverse happens. Inversely, that's typically when your bull market stops, is when everybody thinks it can't go down, and that's pretty much when it does. So I'm not thoroughly convinced that this isn't done moving higher, because I use social media for sentiment, and now everyone's calling for a correction, and so when people do that, typically makes me bullish. Here's your Dow. This is the weekly chart as well. As you can see, that 200 holds fairly well on the Dow as well. We didn't get quite the touches here, so I also used my 120 EMA on that. But nothing bearish about the Dow. You had your dip down here and crushed it up. 33,841, that's your 3-year volume. So again, if we came back down, that would be a level for sure on the Dow that I would be looking at, because it didn't hold this first time. So that would be an excellent area to get long if we were to dip down. Pending risk still in the bond market. I still hold that bond auctions are the new Fed days. I think we need to really kind of keep our eyes on that. It was the 7-year, I think it was on Thursday or Friday that hit, that all of a sudden, I was just like, what the hell was that? It was a quick 10-point dip. I think that if we were in normal circumstances and not in a holiday market, we would have gotten more of a downside shift from that. So that's something I'm definitely watching. Here's your traverse down. This is the 30-year futures. I also use tilt on the equity side, but this is So you saw some deep selling here, deep selling here. China and Saudi Arabia are no longer buying our long-term debt, and this is obviously causing strain. Now, if they're not buying the long-term debt, they're probably buying U.S. equities, and that's probably why we see this overall jump, right? So it doesn't mean that the economy is great and everything's rosy and, unicorns. This is probably just outside money coming in. And I would argue that this rally here from post-COVID lows was the same thing. A lot of it was optimism, right? It was a good shakeout, and then everyone started buying again. But also, I think that there was a lot of foreign money in that as a safe haven. So we came down to a pretty critical level here in the 30 years before this reversed. And if you notice, this reversed just like this reversed, right? So those two kind of coincided, but the difference is this was definitely on the lows. So this is a 10-year volume chart. So your 30-year bonds were on the lows here. And it's stick saved, and we've rallied back. Now, this is my concern with more of a macro is this heads down. If we get that, then there's probably going to be more issues with the equity markets. But again, I don't see a catastrophic, sell-off, market crash, whatever, pending no crazy disasters. So crazy disaster-wise, moving forward, we have obviously election year, so it's political chaos year. We do have world war risk that could spark in the next year for multiple reasons on multiple fronts. And I don't know how bearish that would be unless we're directly attacked. That could be bullish since, everywhere else who is in conflict will be buying U.S. equities to get their money off the mark. So always thinking capital flows. We do have tsunami risk for East and West Coast, which is fascinating to me, but that has come to my attention by another valuable source of mine. So I'm curious to see if that transpires. And then bond risk, I think, is really kind of what we're looking at. Gold as well, right? Everyone thinks you could see a bullish year for gold. I don't think the dollar index is going anywhere. I don't think gold is going anywhere, but if the dollar rallies hard, I could see a depressed commodity cycle. So we'll see. Watch the dollar, watch the commodities, especially your physically traded or physically delivered commodities, your agriculturals, stuff like that. Those took a deep dive over the last few days, actually. So we'll keep an eye to see. But I think that more than likely you'd see a rebound of that. If that's the case, dollar should come down and gold should come up with that. So anyway, again, I don't see anything catastrophic wise. What we do hope for is what I hope for is just, probably a little bit wider ranges, more swinging and more volatility, because that's kind of where we make our money. So it doesn't really matter whether we go up or down. The reason I use more of a macro is because I want to know if I should be selling rips or buying dips. And that's really the only reason I'm looking at sentiment. And as of now, over the last 9 weeks, buying dips has been the way to go. So we wait for the market to drop into whatever levels we have. Once that reverse happens, PCS and you're out. Will the market structure change to selling rips? Eventually, yes. To what extent, I don't know. But again, I just don't see any, 1929 market crash. Everybody's, chaos. I think that we get a controlled sell-off into a good level, and then we return back into kind of a bullish market. So anyway, that's kind of my update. That's kind of what I'm looking at. I don't see the end of the world. I guess I'm bullarish. I'm not married to any side, nor should you be. Permanent, perma-bull, perma-bear, that's just recipe for disaster. So if you just kind of come in with an open mind and say, hey, listen, is this a bearish structure or a bullish structure, then trade from that aspect. I've been working, I've fallen victim to that in years past, and I just I don't care enough anymore. I just want the day to day. So happy New Year. And hopefully we'll have a profitable year. I will continue with morning updates best I can throughout the year. And we'll talk soon.